Wall Street is closed for the day, and it was one of those sessions where the index levels didn't tell the whole story. On the surface, the tape looked fairly contained, but under the hood we saw some real rotation. Consumer staples catching a bid, software getting hit again, precious metals turning volatile, and healthcare digesting some tough news. Let's start on the upside, where one of the clearest winners was PepsiCo. According to reporting from MarketWatch, the stock rallied toward a 13-month high after an earnings beat and a dividend hike of about 4%. Management also talked about cutting prices on core snack brands like Doritos and Cheetos after customer complaints about affordability. That's a notable shift. For the last few years, consumer staples have leaned heavily on price increases. Now, with the consumer more stretched, Pepsi is trying to protect volume and loyalty while still delivering profit growth. Traders will see that as a sign that strong brands can thread the needle between pricing power and affordability, and it puts a bit of a spotlight on how other packaged food names might respond. On the flip side, one of the biggest areas to handle with care right now is software. As MarketWatch highlights, software stocks continue to sink, extending what some analysts are calling historic underperformance. The line that stands out is, momentum is a powerful force in capital markets, and at the moment, it's just not on software's side. After a multi-year run where high-growth names could do no wrong, the bar for valuation, profitability, and AI credibility is much higher. Professionals will be watching whether this remains a grinding D-rating or whether we finally see a washout that resets expectations. We also had some meaningful single-stock stories in healthcare. Pfizer finished lower after what MarketWatch described as a mixed response to weight loss drug data for a candidate set to compete with Eli Lilly's Zepbound. The study results were encouraging on efficacy, but the company simultaneously guided to a profit decline, citing pressure from the Trump administration's policies on pricing and tariffs. That combination, pipeline promise but near-term earnings headwinds and policy risk, left investors with more questions than answers. Merck faced its own reckoning. Its outlook for 2026 came in below expectations, and the stock fell as the full-year revenue and profit guides disappointed. Reporting from MarketWatch framed this as a make-or-break year for Merck's pipeline. That's classic big pharma tension. As key drugs age, everything depends on the next wave of approvals. When the street doesn't get the reassurance it's looking for, multiples compress. Healthcare investors will be tracking upcoming trial milestones very closely here. Stepping back to macro, the Federal Reserve narrative took an interesting turn. Greg Robb at MarketWatch reported that President Trump and Fed Chair-designate Kevin Warsh are not holding a joint press conference, breaking nearly 3 decades of tradition around Fed nominations. Economists quoted in that piece expressed surprise and disappointment, and markets are reading this as a possible shift toward a more opaque Fed, with less public signaling and fewer unscripted remarks. If we are indeed entering a less Fed talk era, that could mean more uncertainty around rate paths and a heavier reliance on hard data and official statements. Rate-sensitive sectors, banks, housing, utilities, will be especially attuned to how Warsh communicates once he's at the helm. Speaking of housing, affordability remains a clear macro stress point. MarketWatch highlighted 2 charts that show why buying a home is the hardest it's been in decades. Persistent high prices and still elevated borrowing costs mean that even as inventory improves slightly in some markets, the math remains brutal for many buyers. That feeds back into consumer confidence, construction activity, and even regional bank loan books. Real estate-linked names and home builders will be trading not just on rates, but on how this affordability squeeze evolves. Now let's talk about those sleeper themes that might not drive the indices today, but could matter more tomorrow. Precious metals had a fascinating session. Gold and silver, which had just endured a record-setting shakeout, including around a 13% drop for gold over 2 sessions, snapped back with a rally today. As Myra Safong and Steve Goldstein write for MarketWatch, the recent moves have had a meme-like flavor to them. Outsized swings driven in part by speculative flows, social media buzz, and technical breaks, rather than just inflation or rates. Traders in that space are watching volatility, positioning, and whether retail flows remain elevated. Because when meme-style behavior hits traditionally defensive assets, risk management becomes paramount. In the consumer and services space, Darden Restaurants made waves by effectively saying goodbye to its Bahama Breeze chain. MarketWatch reports that half the locations will be shuttered, and the other half converted into other Darden concepts like Olive Garden and its peers. That's a reminder that even in a reasonably healthy U.S. consumer environment, restaurant traffic is shifting quickly, and operators are rationalizing underperforming brands to focus capital where returns are better. It's a background story today, But for longer-term investors, it's part of a broader theme: footprint optimization and brand concentration across retail and dining. We also saw a notable corporate finance move in tech infrastructure. Oracle is lining up a monster $25 billion debt financing, with the company signaling it could raise up to another $25 billion here via equity or equity-linked offerings. Joy Wiltermuth's reporting at MarketWatch points to real anxieties around the cost and scale of funding AI buildouts, data centers, chips, networking, and software. The AI race is no longer just a product story. It's a balance sheet and capital market story, and bond and equity investors alike will be watching spreads, demand, and dilution risk as these deals hit. Looking ahead to tomorrow's session, the key things I'm watching: how software trades after today's hit, whether PepsiCo's consumer staples strength broadens out to other household name brands, how healthcare digests the Pfizer and Merck headlines, and importantly, whether we get any additional clues on how a Warsh-led Fed will talk, or not talk, to markets. Housing affordability, metals volatility, and big-ticket AI funding plans all stay on the radar as secondary but important drivers. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Stormstock Solutions, I'm Grant Mercer,